If you're looking for the best dividend stocks, then it's important to remember that the best ones aren't just the ones that give you the biggest payouts. First off, don't just chase the high yields. It's tempting, I know. But going after stocks just because they promise big dividends can sometimes lead you into a trap. I recommend you focus on companies that have a solid plan for their dividends. Companies that have good management teams that really support their dividend strategies. Even the best-looking stocks aren't a guaranteed win. But if they've got a good history of paying dividends and a strong position in the market, they're usually a pretty good bet. But with the way things are going in the economy and the stock market, it's also smart to look for quality stocks that are a bit undervalued. I'm Will, and I teach people about investing, personal finance, and money. I've walked the path you seek, and today I have several businesses and investments that provide me income every single month, meaning I never have to work another day in my life. If you plan on becoming financially free, be sure to hit the subscribe button on the channel and hit the like button if you find this video valuable. In this video, I'm going to talk about the 5 best dividend stocks to buy in 2024. But please keep in mind that this is only my opinion and should not be considered as investment advice. It is provided for informational purposes only. Every investment and all trading involve risk, so you should always perform your research prior to making decisions. Okay, so the first dividend stock I believe is a solid buy is ExxonMobil. ExxonMobil. You may have heard of them already, but if not, they're a big name in oil and gas, and you can find their stock on the New York Stock Exchange under the ticker XOM. Right now, their stock price is around $100.90, which is a bit lower than it was back in October when it was around $120. But here's the thing. I believe there's a lot of potential with ExxonMobil. Their dividend yield was previously about 3.72%. That's pretty decent, especially in the oil and gas industry. Now, ExxonMobil is at the top of my list for a reason. They've got some pretty interesting things going on. For example, they announced plans to buy another company called Pioneer Natural Resources, which I think is a really smart move. There was a bit of a rough patch in 2020 when Exxon struggled to keep up with their dividend payments, but they've been making some smart moves to cut costs and spend their money more wisely. Because of this, they're in a better position now to keep paying out dividends. They even managed to increase their dividend by 4% recently, which is great news for investors. And here's the cool thing. Experts think Exxon's stock is actually worth more than what it's trading at right now. They estimate it's worth about $123, but it's currently trading 20% below that. So not only are you getting a good dividend with a strong company, but you're also getting the stock for less than what it's really worth. All right, the next dividend stock on my list is Verizon Communications. Verizon Communications are a big player in the telecom services industry. You can find their stock on the New York Stock Exchange under the ticker VZ. One thing that really stands out about Verizon is their dividend yield, which is around 7.09%. That's like the interest you earn on a savings account, but in this case, it's what you get for owning their stock. And personally, I think it's a pretty attractive number. Their stock price is currently trading at about $37.37, which is very interesting because experts think it's actually worth more than $54 per share. That means it's trading 31% below what it's really worth. Back in 2022, it was even trading at $55.11. So anyone buying Verizon is definitely getting a bit of a bargain right now. But why is it so cheap? Well, the market is slightly hung up on some challenges Verizon is facing, especially with adding new wireless customers. But now the tide is turning. The wireless industry is getting more balanced, which means companies like Verizon could start making more money in the coming years. Even though Verizon's customer growth has been modest, they're still making good money, especially when it comes to free cash flow. That's important because it's money they can use to pay out dividends, which is something they're really committed to, as they're planning to use about 65% of their cash flow in 2024 just for that. It's likely they'll hold off on buying back their own shares for a bit and focus more on maintaining their dividend payments. This shows that they're really serious about keeping their investors happy with those regular payouts. On to number 3, we have Johnson & Johnson. Johnson & Johnson, a name most of us know, are heavy hitters in the drug manufacturing world. You can find their stock on the New York Stock Exchange under the ticker JNJ. Their dividend yield is about 3.02%. And here's something impressive. They're what you call a dividend aristocrat. That means they've been upping their dividend payments for at least 25 consecutive years. Their stock is currently trading at around $155.16. Now, the experts think it's actually worth a bit more, like $164 per share. So it's trading about 5% below what it's really worth. What makes Johnson & Johnson stand out? They've got a diverse source of income, offer essential products, and they're really good at generating cash. This earns them what's called a wide economic moat rating. Experts pointed out that Johnson & Johnson had some solid results in their third quarter earnings. The market isn't fully appreciating just how good their product lineup is. Sure, the stock's current yield of 3% may not seem that exciting, as rising interest rates have caused investors to seek higher yields from equities. However, the quality of the dividend, including its robust coverage and satisfactory pace of expansion, remains compelling. The fourth dividend on my list is PepsiCo. PepsiCo, as you probably know, is a huge name in the non-alcoholic beverage industry. You can find their stock on the NASDAQ under the ticker PEP. Now, PepsiCo's dividend yield is about 2.87%, and they are also a dividend aristocrat, which is really just a fancy way of saying they've been increasing their dividends consistently for a whopping 51 years in a row. Recently, they've had some great results thanks to their smart moves in both snacks and beverages. They're always coming up with new products and finding efficient ways to reach their customers. Experts at Morningstar thinks PepsiCo's stock is actually worth more than its current trading price. They peg it at around $180, but right now it's trading at about $167. So although not much, it's still a discount. And a key point to make is that PepsiCo isn't just resting on their laurels. They've been raising their dividend for over a half a century, and it looks like they'll keep increasing it by about 8% annually over the next 10 years. They've got a track record of success, they're continually innovating, and their dividends have been growing steadily. Last but not least is Altria Group. Altria Group, they're a big name in the tobacco industry, and you can find their stock on the New York Stock Exchange under the ticker MO. Here's something that really stands out about Altria. Their dividend yield is 9.04%, and their stock price is currently trading at around $41.75, which is lower than what some experts think it's worth. They believe it should be around $52 per share, so that's a 19% discount. Altria isn't just sitting around, though. They're actively working on alternatives to traditional cigarettes. Their strategy in developing cigarette substitutes is pretty smart. They've been able to keep increasing their prices, which helps offset the decline in cigarette sales. This strategy is key to keeping their revenue, earnings, and dividends growing. Dividends are a big priority for Altria. They aim to give about 80% of their earnings back to shareholders as dividends. The company's commitment to consistently paying and increasing dividends makes it an attractive choice for investors looking for steady income. Investors should consider the payout ratio, profitability, and growth metrics when assessing the sustainability of these dividends. The payout ratio indicates a high percentage of earnings being returned to shareholders, which could raise concerns about future growth funding. However, the company's strong profitability rank and growth rank suggest a resilient financial standing. Dividend investing is a powerful way to generate passive income, and if you're interested in building wealth with this strategy, then check out this video here.